versus own analysis. And you'll understand this chart. It says lease versus own analysis, talks about user assumptions, purchase assumptions, and lease assumptions. Okay, so you are a business, naturally, and you have no idea what to do. You need about, let's say, 40,000 square feet, and you have money. Money's not a problem, but does it make sense to lease or to purchase? And the only way to really look at that is to develop a key set of assumptions. And so the chart that I gave you has the key assumptions that you should be aware of within your own company, because the assumptions are different for every company. At the top, I'm going to quickly run through these and just tell you some key points and how it relates to maximizing the value of your asset. Ordinary income tax rate. In the example we're doing here, I'm using 25 to 30%. Capital gain tax rate. These are all accountant questions. 25 to 28%. Cost recovery or recapture rate. I use 25 to 28%. Your companies may be different, but you're going to need some assumptions in this analysis. After-tax discount rate. This is a very important rate that is used in this analysis and any other time value of money calculation. The discount rate is not necessarily the interest rate. The discount rate to any company is different. For example, I may be very, very positive about the future, and I think that there's no inflation premium, there's no chance the world's going to get snowed over and we're going to be in a polar vortex, and I'm just going to assume that everything's going to be fine, in which case maybe my discount rate is close to what the banks have today of 5%. It's not very realistic, especially we just talked about inflation. So you already know right off the bat, it's probably going to be 2 to 3% higher there. And any other risks or opportunity cost intrinsic numbers that you want to back into that rate. 10% is the most common example you'll see in a time value of money calculation, mostly because it's easy to calculate, being at 10%. However, it is somewhat realistic based on the current day's interest rates. Under purchase assumptions, so you're going to want to mark down in this example, go through both situations. So number 5, purchase price. My example, $1.5 million. Number 6, acquisition costs. I assumed loan acquisition costs of approximately 1%. Number 7, acquisition loan amount. We talked about SBA financing. This is where that comes in. Normally it's 80% loan to value. However, if your company would be doing SBA financing, it'd only be about 10% down. So that would come into play here. Interest rates, number 8, I use 4.5 to 5.5%. Number 9, amortization period. Please always remember that commercial mortgages are very different than residential mortgages. At best, you're probably going to get a 25-year amortization period. However, 20 years is certainly the most common and something that you can typically run in your analysis. So you'll get a loan from a bank. It's going to have a term. It's probably going to be 3 to 5 years. Every 3 to 5 years, you're going to have to go back to that bank and refinance it. If the property is underwater, that's when you can't refinance, and that's when all heck breaks loose. That's why we monitor the values every year of our properties. So even though the loan is amortized over 20 years, you still have to go back and refinance every 3 to 5 years, and that's a common misconception. We talked about loan term, payments per year, loan costs. Improvement allocation, number 13. That's important for depreciation in this analysis. Basically, it's the amount of your site that is improved versus vacant land. So it's probably going to be 70 to 80%, depending on green space. Useful life, 39 years. That's an accountant number. Number 15, projected value and growth of the asset. Again, this is if you're purchasing. In our example, we use 2%. And then finally, number 17, what do you think you're going to sell? I'm sorry, number 16, what do you think you're going to sell the asset for at the end of a 10-year period? So that whole spiel was a 10-year look at purchasing a facility. Now we want to take a step back And it's a little more simple. What is the cost over a 10-year period to lease that property? So along the bottom, you see essentially some key assumptions. Number 20, lease payment. In our example, I did $150,000 a year, triple net. Remember we talked about always knowing your base rate? If this is an office deal, don't enter in the gross rental rate here. This is where you back out those CAM charges, and you're going to have a net rental rate here. You're going to have taxes no matter where you are. You're going to have utilities no matter where you are. So inflating costs based on some of those expenses doesn't give you a true picture of comparing apples to apples. So it's really fascinating. You have this stream of cash flows over over a 10-year period, lease versus own. And I understand this is a very crude example, but I thought it would be a really good way to understand the concepts that we're discussing. And that brings us to our final page, which is the chart lease versus own. This chart is a very popular chart from CCIM, the the Commercial Certified Institute of Managers, I'll go with, and very renowned group with this incredible spreadsheet. And that's where I got this spreadsheet. We just discussed the inputs, so this is the output. On the top line, you see the lease rate, and essentially since I had the rent flat at $150,000 a year, you just see that going all the way across. And then the bottom line shows you your cost requirements based on present value of the cash flow when you own. And then the big number that's in the star says $691,628. So essentially what this is telling us is that based on those assumptions, it is $691,000 cheaper to own versus lease based on those assumptions. It's a very common example. You don't know what to do, but when you look at it over a period of time based on a set of assumptions, in this example we're using a 10% discount rate, so every year that $150,000 in rent is getting discounted back to the present at a rate of 10%, and you're able to figure out apples to apples in today's dollars which is a cheaper option for you.